to take a look at the markets as we head to the final hour of trading. Obviously, you've got the Dow down 36, but we were down 162. So you've had a big reversal. A lot of this is concerned about interest rates, inflation, a little bit of trade mixed into this, but energy's actually been doing good. S&P is down 2. Dow is down 36. NASDAQ is up about half a point right there, 3/4 of a point. Let's get more on this wild ride. I want to bring in Producer ETFs President Sean O'Hara. And I mean, really, the interest rate story is kind of the backdrop of all of this, even though we're seeing a bit of a reversal with the market today. But there is concern that we have not seen these levels in the 10-year in so long, and that this could have a negative effect, push the Fed, more interest rate hikes, worries about inflation. I mean, what do you think about all of that right now? Should we be worried?
I think it's a little early to be worried. I think, for the whole year, essentially, the 10-year's been poking above the 3 and then getting hammered back down, and mostly by outside non-U.S. buyers. They were able to hedge their currency. Those currency spreads have blown out. It used to be 30 basis points. Now they're 300, so it makes no sense for them to be buyers. So I think that's why rates are peaking up and going a little higher than they have. But 3.25, 3.5 on the 10-year Treasury is not a killer for the overall equity market. I think the equity market will continue to be driven by solid fundamentals, good solid earnings growth, and the environment continue to be positive.
We were talking about this earlier in the show with Steve Forbes and David Bruno, that maybe this makes fixed income a little more attractive to some people. And, a lot of folks did go into bonds during the recession, and especially after this last, I don't want to say crash of the market, but it was a rough time, 2008, the financial crisis. A lot of people, especially the older Americans, are saying, I like the safety.
Yeah, I mean, some people never came back to the equity markets
That's
after
true.
08 and 09. So
True.
This has been the most hated bull market in history. And this year has been a year that, it's been a good year for returns, but it doesn't feel very good.
Yeah.
And I think you'll see some of that going into fixed income as an alternative to potentially buying dividend-paying stocks. But at the end of the day, those folks in retirement need to keep in mind that their life expectancies are very long still, and they've got to invest for the long haul. Mm-hmm. And a 3.25% yield is not going to help them accomplish their goals.
What do you make about the concerns about inflation? And I do want to talk sectors, because in the S&P right now, the sectors that are actually pushing the S&P, even though we're slightly negative still, it's a better market than we had this morning. But a lot of that is energy, consumer discretionary, but in particular the energy side. Those can be some very good dividend-paying, great stocks to sit in your portfolio. Is that a sector you like? And what other sectors? We
run a strategy called U.S. Cash Cows that uses free cash flow as the screen. So we're not interested in sectors so much as companies that generate a lot of cash. Mm-hmm. We have been underweight energy until fairly recently, but now it's starting to pick back up as oil prices go up.
Yeah.
We're overweight technology, but we don't own any of the FANGs. We own the chip makers, which have been terrific investments.
So you're not going for the Facebooks and even like an Apple, you're going for the actual hardware.
Yeah, I define it as hard tech versus soft tech, social media tech versus the backbone. And the backbone of technology is driven by 4 big things: artificial intelligence, autonomous vehicles, e-commerce, and streaming. And so those types of names are like, and we also own a fairly big slug of consumer discretionary. Bricks and mortar retailers like Nordstrom's has been a terrific name for us this year. It's screened in based on their free cash flow yield.
Yeah, retail got so beat up over the last, several years because, they're all going to close. That's not the case.
No, if you look at Macy's, Nordstrom, Foot Locker, Dick's Sporting Goods, Polo, Ralph Lauren, all have had terrific returns this year.